So in today's video we're going to take a look at an issue that's troubling quite a few investors at the moment, which is how do you compare technology stocks? Lots of hype around at the moment with everyone waiting for the Facebook IPO. We've already had LinkedIn launching and Ren over in China. So lots of technology action happening in that space. The question for investors is, how do you know when a technology stock is cheap? Because that's one of the starting points for should I try and buy in. Now, pricing technology stocks is a little bit like pricing other stocks. There are a couple of well-known techniques, but with technology stocks, young, fast-growing companies, you hit a problem with one or two of the classic valuation techniques fairly quickly. So in this video, we'll do a quick overview on how you go about valuing a stock and look at, in practical terms, how an investor can compare two technology stocks and which of the valuation ratios make most sense in that context in terms of deciding, have I got a cheap stock on my hands, have I got an expensive stock, do I want to buy in at all? Right, so valuation, how's it work? This is going to be a summary in this video, we're not going to go into all the detail, but basically you've got two choices. If you're trying to work out, is a stock cheap or expensive, you can either do what I'd call a bottom-up valuation, or you can do a relative valuation. If you like, imagine selling a house. You can either ignore the price that all the other houses in the street have sold for in the last 6 months and work out bottom-up what you reckon you could rent your property out for and try and work out a unique valuation for it. Perhaps there's some way of predicting the rental income from your property, discounting that back, and therefore working out what your property is worth. Or you can simply look at other properties in the street, or you might do a bit of both, of course. So you'll use other properties in the street as a reference point, but your own house may have some unique features that make it difficult to compare exactly to anything else in the street, because you've got an extension, you've got a fifth bedroom, you've still got an outside Victorian toilet. Doesn't matter what it is, but you may not be able to just go, well, the one next door sold for this, so mine's worth that. Similar problem valuing companies and stocks. So, two approaches. Bottom up. Now, this is a little bit tough and a little bit unsatisfactory for tech stocks, because two basic techniques. One, what's called, rather grandly, discounted cash flow, or DCF. And then the other one I'll call asset-based. Now, this is something most investors don't want to have to do. It involves a lot of work. Investment bank analysts spend a lot of time trying to do it. And the good news is that you don't really have to repeat this trick. It's not really something that most investors, until they're fairly experienced or have a lot of time on their hands, want to get into. But it is a sound technique. It involves thinking over the next 20, 30 years what a company can earn. So you take revenue minus costs to give you an annual cash flow. Basically projecting out into the future 30 years worth of cash flow, and then you need to make sure that each year you're comparing apples with apples. So in other words, £100 of cash in, let's say, generated by a company tomorrow is worth a lot more than £100 in 30 years because of inflation. So you need to basically discount the cash flows in the future back to a current value today. And then if you add them all up over 20 or 30 years, in theory, you get to a lump sum which represents the value of your company. Now, if that sounds like quite a lot of work, it is. If it sounds like you need to make a lot of assumptions and do some slightly suspect sounding stuff like forecasting cash flows 30 years in the future, you do. So it's not a perfect technique. Valuing companies is never a science, it's more of an art in a way. But nonetheless, it is a technique used in quite a few situations. Now the problem with tech stocks is this. What if the technology stock you're looking at doesn't generate positive cash flow? What if, to borrow from the dot-com boom of the late 90s, it's burning cash, not generating it? Makes projecting and discounting quite difficult. Not impossible, but quite difficult. So another technique, again, doesn't work terribly well for technology stocks, but it's there, is asset-based. I could simply say, discounted cash flow, projecting the revenue a company is going to generate in the future and then adding up all that future revenue to get a lump sum in today's terms sounds like quite hard work. So maybe what I'll do is just look at a list of the company's assets now, come up with a market valuation for them, and Bob's your uncle. There's the value of the company. Fine, but think about technology stocks. Often the assets are pretty low. Most of the assets in a technology company are brand, market share, and people, not furniture, buildings, and plant and equipment. So that can make an asset-based approach also a little bit difficult. So most investors, for two reasons. One is it tends to be easier to do in a way, and secondly, it's arguably more appropriate to do or go for some sort of relative valuation. And what we mean by a relative valuation is something ratios based. In other words, most investors are happy to leave the investment banks to do some of this stuff, and for a tech stock this wouldn't work too well anyway, and frankly shortcut it a little bit and go to what's called relative valuations. This is the idea that, you know, if you know roughly what a similar property in your street is selling for, maybe that is the best way to get a handle on what your house is worth. So relative valuation in the context of shares means ratios. But the question with a technology stock is, which ratio are you going to look at? So for example, are you just going to say, well, the average technology stock has a PE ratio of 15, the one I'm looking at has a PE ratio of 10, therefore the one I'm looking at is cheaper? Well, that would work fine, were it not for the fact that PE ratios don't work too well in the technology sector, and here's why. Okay, basically what you'd like to be able to do as an investor is have a simple one number answer to should I invest, and therefore you're looking for some way of getting to a ratio that's appropriate for this kind of stock. But here's the problem: if I were to put a quick profit and loss account, a quick P&L up on the board. Now, we've done a video on what is profit, so I'll keep this fairly tight for this video. What we would do is say, well, sales, we know, it's in pounds, millions. Then we take away what are called cost of sales, and that generates what's known as a gross profit. So sales minus direct cost of sales, things that vary with each sale, like light, power, printing costs for a magazine, gives you your gross profit. Then, in this statement of what a company's made in 1 year, you knock off what are normally called operating costs. And that gets you down to an operating profit. Operating costs, broadly speaking, overheads, sales, distribution, administration costs. So now you've got to an operating profit for the business. From there, you take off the financing costs of loans, bank loans, that kind of stuff. So your interest charges go out next. That gives you a profit before tax. Then you take off tax, that's corporation tax for a company, and that gets you down to a profit after tax. Now I'll stop there. The next line would be dividends. So if the company's going to pay some of this out, obviously the X's would be real numbers, but if the company's going to pay some of this out as dividends, that will come next. Now the question is this: if you're a technology investor and you're thinking, well, what I'd normally do in another sector is I'd look at the average PE ratio for the sector, and then I'd look at the company I'm looking at, and if it's lower, that suggests maybe there's a bargain. If I can find another reason to invest, that's a good starting point. Fine, but here's your problem. Earnings per share, which is the key component of the price to earnings ratio, because the PE ratio, as I explained in another video on PE ratios, is the current share price divided by earnings per share. If you're not sure about that, by the way, do take a look at that other video, what is a PE ratio. So basically that uses this number here, profit after tax. So that number feeds EPS and the PE ratio. With a tech stock, here's your problem. What if the company is not making profits? Answer: the ratio doesn't work. You need an earnings figure to do a PE ratio. And that's the problem you've got at the moment with a lot of tech stocks. There is no earnings figure, so you can't do a PE very easily. So you think, well, that's not going to stop me, so let's keep going. How about I move up the profit and loss account? So if that is negative, how about I move up and try and find a positive number? So maybe if I go back up the profit and loss account, take out the tax charge and the interest charge, maybe I can start working on some kind of ratio that uses the operating profit figure. Or maybe I can even take out two of the more subjective costs that sometimes afflict profits, as well as interest and tax. Maybe I can take out depreciation and amortization and convert that into a number called EBITDA. In other words, operating profit and EBIT are the same term, earnings before interest and tax, and some analysts like to back out depreciation and amortization. Now again, if I'm running a bit quickly on that, do take a look at my video, what is EV EBITDA, and that's explained in more detail. So I won't bash that to death here. So, in other words, I can look for a profit figure further up the profit and loss account by taking out costs. I've got more chance of getting to a positive number, but I can then slot into a ratio, perhaps EV to EBITDA, and try and come up with a comparison figure that way. Problem with a lot of technology stocks is you still haven't got a positive number. And that's because all they're doing is trying to grow market share and not making a lot of money in the process. Okay, LinkedIn turns a little bit of a profit, but the likes of Ren don't. So what next? Now, one of the most popular technology valuation ratios says actually the only positive number in this whole statement is that one. For quite a few tech stocks, the only thing that is a positive number on the whole page is the sales figure. They are at least selling something, even if they're not doing it very profitably. So, is there some way of comparing technology stocks just on the strength of their sales numbers? Well, the problem is the absolute sales figure tells you nothing, because obviously a small company will sell less than a big company. But is it a bargain? You can't answer that question just on sales. As Sir Alan Sugar once said, you can sell £10 notes for £9 any day of the year. You'll have a massive business, but it's not a business. So the question is, how can I compare companies using the sales figure? And the answer is something called the price to sales ratio. And that is popular in this sector. Basically, you can take the current market capitalization, if you have one, that's the price, and divide by 1 year's sales to get the price to sales ratio. Or you can take the current price per share and divide by sales per share, just like you do of the PE ratio, except it would be price per share divided by earnings per share. And that'll give you a number. Now the number can be pretty big. For Google, at the moment, it's about 6. Or 6 times. Now, two things I want to say about that. Look around the technology sector at the moment and you'll find some much bigger numbers. Okay, the likes of Ren were trading on 70 to 90 times, and even LinkedIn came in at over 30. You've got to ask yourself the question, you've got to ask yourself two questions actually. Number one, Google is on 6. How likely is it that any other stock can be trading on 6, 7, 10 times Google's number? Now, I don't have an answer to that for everybody, but the answer for me is that sounds a little bit toppy to me. So, price to sales is a good starting point for tech stock valuations, and there are some pretty heady valuations around at the moment. Second question is this. You are basically comparing companies purely on the strength of their sales figure. These companies may never make a profit, and that's something else you've got to think about when you invest in the tech sector. Yeah, as an investor, it's no use investing in something that just sells. At some point, you've got to see a way that that can be converted into profit and cash flow. Otherwise, you can buy the share today, and frankly, it'll never pay you back, unless you manage to offload it to someone who's prepared to pay an even higher price somewhere down the line. So, I would say, yes, the price to sales ratio is one of the few ratios that works in this sector. You can't use price earnings very often, because you haven't got earnings. Price to book, that's another one we look at in a separate video. There is no book value of assets really to use. These companies tend to be asset light, as I'd call it. So price to sales becomes almost the only ratio available. But the trouble with that is, it's tempting because it's neat, it's one number, but it's also dangerous because some of those price to sales ratios are getting a little out of hand right now. Now, One final point. Is it possible to value a technology company, and watch out for this, this is when you know things are going crazy, is it possible to value a tech stock without even a sales figure? What if it's just an idea? What if it's just a concept? What if it's just a bunch of people with ponytails and no suits, basically selling you the idea that in 15 years this will be the next biggest thing since sliced cheese? The way they might do that is to say, don't worry about the fact we don't sell anything, let alone make profits, let alone generate cash flow, let alone have any assets. Don't worry about that. What you want to do is price us on price per page click, price per eyeball view. In other words, you start making up relative valuation ratios on the strength of how often someone clicks on the website page. And if that sounds a little bit crazy, it is for my liking. So you can tell for sure when we're going to get into another tech bubble, when people start actually talking as if this makes any sense. Okay? For me, two problems. One is that is a million miles away from profit. It's far too far away from profit for my liking. And secondly, unless I really understand what a tech stock's doing, I'm not going to buy into it. So if you're thinking, what is a LinkedIn? What is a Facebook? What is a Google? Hopefully you know what that one is. Then really this sector's probably not for you in the first place. So don't be drawn in by analysts persuading you that the price to sales ratio makes some kind of sense.